Only 2 countries on Earth commonly issue a 30-year fixed-rate mortgage. One of them is the United States, the other is Denmark. Everywhere else in the developed world, from Canada to Britain to Germany to Australia, home loans run on variable rates or short fixed terms that reset every 2 to 5 years. What most Americans treat as the natural way to buy a house barely exists outside these borders, and it did not exist inside them either. Until 1934. The typical American home loan back then ran 3 to 5 years, charged interest only, and covered barely half the price of the house. When the term ended, the entire balance came due in a single payment. People did not pay off their homes. They refinanced again and again for as long as they owned the place. That same skeleton is what a household signs onto today when it borrows $400,000 at 7%, then hands the lender roughly $558,000 in interest across the next 30 years. That is more than the price of the house itself. None of it grew out of the market. Every piece of it was designed, and the year it was designed explains almost everything about what it costs you now. By the winter of 1934, the American mortgage system had fallen apart. The Federal Home Loan Bank Board counted the damage on January the 1st that year, when half of every home mortgage in the country sat delinquent, and lenders were foreclosing on roughly 1,000 homes every single day. The loan itself was the reason. A mortgage before the Depression was a short balloon note that ran 3 to 5 years, paid down no principal, and dropped the entire balance on the borrower when the term ended. The whole arrangement held together only as long as people could refinance at the close of every cycle. Credit froze after 1929, and that refinance door slammed shut. Owners who had never missed a single payment lost their homes anyway, because the loan was never built to be paid off. It was built to be rolled over. Look back now, and the fix seems obvious: a longer loan, a fixed rate, a slow and steady paydown. A long fixed loan, though, handed private lenders a problem none of them wanted. A bank that lent at a fixed rate for 20 or 30 years stayed exposed for 20 or 30 years. And if rates climbed or the borrower walked away, the bank ate the loss. Nobody was going to offer a low, fixed, long-term rate, with no one standing behind the risk. The long fixed mortgage, in other words, was not some better product sitting around waiting to be invented. It needed a guarantor, and somebody had to decide that the federal government would play that role and put it into law. That decision arrived in the summer of 1934. President Franklin Roosevelt signed the National Housing Act on June the 27th, 1934. A task force led by Mariner Eccles, a Utah banker working out of the Treasury, had drafted it, and the law did the one thing no private market ever would. Working through a brand new Federal Housing Administration, the government agreed to insure the loans, covering the lender whenever a borrower failed. That single guarantee is what turned the long, fixed, fully amortizing mortgage into something real. Title II of the law laid out the terms: a loan running up to 80% of the home's value, paid off in full across the life of the term, carrying a fixed rate the government now stood behind. The 20% down payment, the fixed rate, the full paydown, every piece of it was written into law in 1934. Here is the detail that rarely survives the retelling. That original FHA loan was not 30 years long. It was capped at 20. Congress did not clear the way for 30-year terms until 1948, and the longer loan only took over as the default through the late 1950s. The number Americans now treat as timeless started life as an amendment to an emergency measure. 4 years later, in 1938, Roosevelt asked the government to charter Fannie Mae, a buyer for those insured loans that freed lenders to write more of them. A mortgage became something you could bundle, sell, and trade, and that secondary market is the machine the entire system still runs on today. Fannie Mae and Freddie Mac together now guarantee roughly $7.6 trillion in home loans, close to 59% of every mortgage balance in the country. Here is where it lands on you. A household's buying power gets set by the monthly payment it can carry. The 30-year term pushes that payment as low as it will go, and home prices climbed to swallow the difference. The long term never only lowered the payment, it raised the price of the house. That is how a $400,000 loan at 7% ends up carrying $558,000 in interest, sitting on a 20% down payment, a fixed-rate structure, and a picture of the family home drawn for the American economy of 1934. The assumptions were never updated. The loan is still running on them.